Well, let's take a look at some further investment opportunities, what we're seeing, particularly as far as equities, given what's also going on at a macro level at the moment. Sean Hickman, research lead from Market Matters, joining us now live. Sean, good to see you.
Nice to be here.
All right. Interesting to see what we saw on markets overnight, particularly as those bond yields continue to move higher. The US dollar strengthening and equities suffering in part as a result. How do you paint the picture at the moment, what you're seeing?
I think we're seeing the market moving through contracting cycles. So the things that would have taken in the past 6 to 12 months are unfolding in 4 to 6 weeks. At the moment, the market's got the bit between its teeth that bond yields are going up, inflation's going up. We saw it especially last week in the UK where inflation went above 10%, gilts surged to, I think, 40 years highs. And I think the rest of the world's playing a bit of catch up ahead of Jackson Hole. We see bond yields going higher.
All right. What? Because you're forecasting that the Fed, you mentioned Jackson Hole there, that do you think we're going to get some greater certainty as to where the Fed is taking its policy and perhaps whether we're going to see a 50 or 75 basis point hike next month?
Without doubt, but bond yields are looking a little bit further out. Especially the 10 years, they're looking at what's coming next. Where's the inflation read through? And then beyond that, they're going to look at what's going to happen from a recession point of view. So we saw with equities, in June, they put their major lows in when all the bond yields made highs. It wasn't until July where we saw the recession fears come in and all the resource stocks make their lows. So things are happening out of sync. And at the moment, we think we're going to see wage pressures, concerns around inflation, keep pushing up those bond yields, at least for the next month or two.
So you feel as though perhaps inflation globally is going to remain stubbornly high for some time yet, as obviously central banks try and get on top of it. I was just looking at a research note from Citi as far as UK inflation is concerned, that it's going to be about 18% by January.
I read 13 or 14, but I think what we're seeing with these bond yields is it's a sentiment-driven market. So at the moment, the sentiment is very much around inflation's back in town. It was gone 2 weeks ago. We saw the huge run-up in all the tech stocks. At the moment, inflation's back in town. Jackson Hole's coming up. We've already know that they're talking tough on inflation. Wage pressures are building. So I think we've just gone through another cycle where inflation's the key.
All right, and I just mentioned what's been going on in crypto markets at the moment. Do you see that is some sort of harbinger of what would likely to occur on equity markets, or vice versa, perhaps?
We're not really big into cryptos. It's not our thing, but there are a very, very good leading indicator for spare cash. So they tend to lead where equity markets, risk assets are going. At the moment, they're telling me they're going down. As bond yields go up, they follow very, very closely inversely. So as the bond yields are threatening to make new highs, the US 2 years almost made new highs last night. Our 3 years are getting close. The 10 years are all lagging because inflation isn't quite as in the front of people's minds. But I think cryptos go lower.
All right, so let's return then to equities and where perhaps you're seeing opportunity, or where you'd be likely to park your holdings at the moment, I guess, in light of those yields continuing to rise. So I'm assuming then tech is not where you want to be.
No, that's complete wrong. Complete opposite. So what we think is actually happening, and I haven't probably expanded this enough, we think we're getting close to the blow off top in bond yields. So I think if these bond yields do push up into Christmas, it's the time to fade the move. I think the rally we've had in tech, especially the quality end, forget people like Zip, the quality stocks that have rallied, some of them have rallied 50%, 40%. Some of those names, if they come back, REA, Seek, stocks like that, if they come back as bond yields go up, we think it's a great buying opportunity.
But now, or are you saying towards the end of the year?
Be patient.
All right, yeah, I guess, because that was my point, I guess, is saying you don't want to be there necessarily now, but you've got to watch for those movements.
Precisely. Lay plans, be ready, have a bit of cash, have a bit of flexibility. The last 2 years, flexibility is key.
All right, well, what are you seeing in the other sectors then? Obviously commodities. If we're looking at a global recession, clearly there's going to be continued pressure there. So how are you playing that?
Well, again, as I mentioned before, we saw in June, we saw the low for the tech stocks as we saw the high for bond yields. And then a month later, we had a savage sell-off in the resources into July lows. I think the same thing could play out again. History repeats. As I said before, cycles are contracting. So I think we're going to see interest rates go up or yields go up, and that will see the resources come under a bit of pressure, maybe after tech. So I'd stay long at the moment. We're overweight. I think the resources look good.
All right. Would you go as far as gold at this point? You're talking
no, gold. We own a bit of gold with Newcrest Mining, and it's proven too hard.
Yeah, absolutely.
It's just not delivering You know, the market's focusing on interest rates. It's not focusing on inflation fears. Until that dial turns, I wouldn't be chasing it.
All right. What about consumer-facing stocks? I mean, obviously we know as those interest rates rise, consumers increasingly under pressure at the moment. So how are you playing that?
A bit the same as tech. Keep some flexibility. Look at the retail stocks. We don't own any retail stocks. We don't own any, or we're not heavily into real estate apart from outside of our income portfolios, but we're looking to increase those holdings into pullbacks. And we've seen that over the last week. I know a week doesn't make a summer, but we are seeing some weakness creeping back into the consumer discretionary space, and I think it would create a buying opportunity.
All right, okay. Let's just return then. So those stocks that you mentioned, SEEK, REA, WiseTech. Yep.
I didn't mention it, but yes,
Yep.
we like it.
In fact, I think we've got some charts, just what you're seeing there. So at what point then would you be buying in?
I think this SEEK, I think you can start accumulating it back under 21, 20, but I'd leave some ammunition in case we see a real panic lows to $19. I think with REA, I'd be a little REA's not there now. I'd be a little bit more proactive.
There we go.
Yeah, REA's rallied stronger than SEEK. I think these markets are showing us they've been showing us the last 2 years, stay with the cream, stay with the strength. REA has rallied really, really well, anywhere around that 115, 100 area. I don't think it'll get back to 100, but 115, 8 to 10% pullbacks from here. I think you can start accumulating.
All right, WiseTech?
WiseTech's even been stronger. I think WiseTech can make new highs, all-time highs this year into Christmas, assuming we get another Christmas rally. Again, 8 to 10% pullback in line with the tech sell-off we're seeing overseas. I'd certainly be accumulating, but I wouldn't be surprised to see WiseTech hold up a bit better. Might be a bit more aggressive in buying WiseTech.